Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod, where we amplify voices from across the agricultural industry. We aggregate those perspectives and seek to elevate our collective thinking around strategy execution. I'm your host, Joe Mosier. When a longtime executive retires and steps aside, there's always a risk of losing so much of that hard-earned wisdom, all that knowledge, institutional knowledge, the steward of the past and what helped you become the company you are today, that it'll walk out the door with them. You know, the insights for what the enduring strategies have been proven to work time and again, but also that sensitive scar tissue earned through the hard way, through making mistakes and learning lessons, paying the tuition. So last year, Carl Dickinson, after 26 years as CEO, navigating more than 30 cooperative mergers, retired from Central Valley Ag in Nebraska, and I had an idea. I've had the pleasure of getting to know and be in periodic conversation with Carl for several years. Enjoyed all of those conversations, always learned a ton, loved his ability to cut through the noise and distill things down to their simplest component parts in a way that really was impactful and helped clarify my thinking. And so when I approached him about being on the show, he said he was interested, but only on one condition. He wanted to talk about where the cooperative system and the leading co-ops within it, where they were headed, not where they've been. Where the industry was going, not the story of his career. And so rather than doing a career retrospective and telling some really good, interesting stories like I originally envisioned, we sat down, we talked about what is impacting co-ops today. But what's true about those co-ops that are performing well despite prevailing conditions, about the enduring value proposition of shared prosperity characterized by the cooperative system, what growth will look like in the years ahead, what Carl expects to see related to further consolidation, and really what good, strong, legacy-focused executive leadership and board governance looks like. It's not the conversation I originally imagined, and that's okay, because it was so much better. Now, a real quick reminder before we jump into today's episode to like and subscribe to the show wherever you get your podcasts so you never miss an episode. You can do it right now. It's completely free. Best way to support the show. And if you're so inclined and you really want to do us a favor, consider leaving us a review and reaching out, letting us know how we're doing. What's resonating with you? What can we do more of, less of? How can we make sure that this content and the time that you dedicate to it each week is as impactful and additive as possible? Thank you, as always, for joining the Pacesetter Pod today. And with that, here's my conversation with Carl Dickinson. Carl, you've got a lot of experience working within the U.S. cooperative system, a lot of experience as an executive through multiple mergers and acquisitions within the space. You've seen a lot of the trends over time around what helps create durable value among the ag co-ops, where some folks maybe get into trouble. We're in this situation today where there's so many multivariable headwinds coming at the co-ops and frankly coming at ag retailers, feed millers, grain companies, all the disaggregated parts of a co-op. But when you package these things all together, as you look at the industry, what's the state of the co-op today from your perspective? And what are you seeing as setting apart those that are really having success in navigating all these headwinds?
Great question. Obviously, we're dealing in difficult economic times in agriculture right now. And I think co-ops being farmer-owned, when it gets tough on the farm, it gets tougher to co-op, obviously. But I will tell you that right now, your best producers, your best cooperatives are looking at this as an opportunity, not as just challenging headwinds. They know that this will cause consolidation both on the farm and at the cooperative level. So I think we got to be real careful. The challenge for the co-op system today is that you're farmer-owned and your membership does not change at the same pace. And so it's very difficult to run a low-cost model in the cooperative system. And there are inherent costs that private entity probably does not deal with at a cooperative, whether that's service inequity or whatever. But probably the biggest challenge that I see that in these times right now is that there's some expectations with as difficult as the economic times are for the farmer, that we start moving to a low-cost model at a time when the farmer probably needs more help. That does not mean asset help as much as it once did. The co-op system was formed off of joining together to build assets and making those assets work for the farmer. We're working in an overserved industry today. So we really need to start divesting of assets. And I know, Joe, you've talked about that on previous podcasts, but really difficult to do when you have this whole range of producers who aren't changing at the same rate, because some producers still depend on old, outdated assets. And so it's really hard to get those shut down. The secondary issue I think that's really, really challenging the co-op world today is just this population, lack of talent. And I hate saying lack of talent because there's tremendous talent in the co-op system, but we're fighting for bodies, right? And nobody in the world wants to do the hard work anymore. And I don't blame anybody for not wanting to do the hard work. But in ag, we've got to execute a planting season and a harvest season and take care of livestock. And there are hard jobs that still have to be done. So those are probably the two biggest challenges I see. We're not a low-cost model because of our asset base, and then this access to people to do the work, frankly.
Yeah. So you said something there. There's actually a number of follow-ups, so bear with me here as we go through them. But you had said that going to a low-cost model might not be what the farmer need because they actually need more help at this time, but not from an asset perspective. So if they don't need help in terms of more assets for the origination and storage, let's say, or even supply of fertilizer, et cetera, where does the help show up? Is it in terms of better agronomic advice, different suite of products and services, different marketing solutions for their production? Where is the help sort of increased if it's not happening at the asset level?
I think you hit them all, right? I think it's agronomic. I think it's helping and running the farm as a business. It's helping changing production practices. It's marketing. The one that we've coined, or I've coined over the years, we've got to learn, and I stole it from David Downey years and years ago, but we've got to learn to grow what people want, the way they want it grown, and deliver it when they want it. And in agriculture, we have traditionally grown what we want, the way we want, and delivered it when we want it. And then we wonder why we end up on the low end of the margin scale. And there's a lot of margin to be had. And co-ops have traditionally, and when I say traditionally, I'm probably going back too far, but have always been leaders and helped leading their membership into opportunities, whether that be around technology, whether that be around agronomic practices, whether that be around, and because of, once again, just the age of information and all the other sources that are out there, I think have lost some of that position, but I think it's coming back because there's just a lot of people that want to help agriculture, but they want to help it and take the margin and not leave the margin on the farm the way a co-op does.
Something you said that's interesting there, it triggered a thought for me, is that the membership is not going to change at maybe at the same pace as the co-op does commercially, or the economics of the business. And one of the things that we see is oftentimes we use I'm not saying this is wrong, but we use the justification or the rationalization that the farm is consolidating. The farm gets consolidating as you have fewer, larger, and then we use larger as a proxy for more sophisticated operator. Their needs are going to change. So just by virtue of getting bigger, you want different things. But if I'm hearing you correctly, you actually can see consolidation at the farm gate occur. So the size increases ahead of actual changes in the way that those farm operations are being run. Did I hear you correctly?
Yeah, I think that's true, that generally the size will change before the operation changes. The operation doesn't change causing the size to change. It's
an inverse from a commercial. Sort of my default setting is the businesses that are doing additive, strategic, and effective M&A, or just growth even absent an acquisition, probably are changing the way they operate, and that becomes the vehicle for growth. But if we put it on its head and say, you might actually have folks getting significantly larger before they change the way they operate, that's a pattern interrupt that you kind of need to sit with and say, okay, what are the assumptions we're making about the farmer's needs, their felt needs, and how do you continue to bring them along?
Yeah. I really believe we are seeing and will continue to see a bifurcation of production agriculture between those that choose to remain smaller and raise food and those that are going to try to win the economic game of reduced costs on the farm and push for just pure yield in bushels. And I think we'll see both those. Already are seeing some of that kind of an aptitude versus altitude mentality that's going on out there. But a lot of growth, if we think about that, a lot of growth in the consolidation on the farm was caused not always because they were great business people. There are those. I'm not saying but in many times they were just great. They had a great set of values. They were great balance sheet managers, right? But it isn't like they had a golden banana that allowed them to become the next biggest farm, right? There was a time where they just outworked everybody, right? And then it was other things that came down the line. But in most cases, it really boiled down to the balance sheet. Could I expand when others couldn't?
And this concept of the acreage adjacent to your existing land holdings has a higher utility and thus a higher value for you than it does to somebody 10 miles away. So the acreage is still in a sort of common production area, certain type of soil profile, certain sort of production history. So on paper, it trades at 12,000 an acre or whatever it is in that geography. If it's set next to you, it's actually worth more to you because of the efficiency opportunity. And so if you have that balance sheet, if you've got that dry powder, as they say, where you can actually absorb that acreage opportunistically when it comes up for sale, because you don't control when your neighbor sells. Yeah. That's actually another vehicle for growth. And so, as you said, it might not be business savvy as much as just being disciplined, good values, and being frugal with the capital in the business.
I mean, we still have majority of our production agriculture still have not changed their business that much in how they go about the production cycle. It just hasn't changed that much. And we see these guys growing and growing and growing. Now there's always those out there that change and they're trying different models and doing different things and bringing in different expertise and that have changed dramatically. And that's why I say that's one of the challenges for the co-op is you got all this membership changing at different rates.
Yeah.
And you, by definition, we have a one member, one vote system. You have a responsibility to try to serve that. And that's an expensive proposition. So
it is. Well, kind of digging in on this then, we've worked with a number of privately held commercial grain operations, kind of in the Western Corn Belt region. And some of the majors have done asset swaps over the years, right? You saw CHS and Cargill last couple of years doing some asset swaps. You see the Andersons coming in and buying locations in South Central or Southern Kansas. You have all this. And one of the things that we heard in some of our work, particularly when CHS would swap some assets, they'd say, well, that's a threat to us because they can pay patronage and we can't. So that would be one of the headline sort of things that make people nervous when particularly a large co-op would come in. But I also hear this concurrent message that the next generation of grower is perhaps less focused on the patronage from the co-op and more wants transparency, efficiency, sophisticated products and services. I guess my question here is the value proposition of patronage an asset or a liability where we set today if you have to give it one rule? I mean, what is the health of that as a business model? And I'm asking you this now after sitting in the CEO chair of a large co-op, but what do you see and hear in the marketplace and the conversations you have, Carl?
Well, I think the first thing we have to recognize is that production agriculture farmers is an asset-intense business that takes a lot of time to build wealth and to do those. And that what I have found is what I hear from a 30-year-old farmer, that same farmer will not be saying the same things when he's 45.
Mm.
So I've heard that my entire career. Well, we don't care about patronage, just build me assets to serve me, all those things. So first of all, it's not an or. We can do either or. It should be an and. I believe well-run co-ops can pay patronage, can invest in assets, can invest in people, can invest in technology, can manage it. You can do it all. And so it's when we start trying to hide behind that, well, we have to make it an or statement. So, but patronage certainly is not as important as it once was. And frankly, I've always said, and I did have the opportunity, I guess, for 26 years to sit in the CEO chair, is I found it was really easy to take care of and have happy owners if I had happy customers. So I have to serve them as customers first and as owners second. We can't hide behind, well, we're a co-op, and so we have to be something less because we pay patronage, or we have to be something less because we're trying to serve this wide expanse of different customers. And because there are so many inherent advantages as a cooperative. You have owners that feel like owners and you win all the ties. Hey, that's big,
Yep.
right? You have huge capital advantages, single taxation, right? The owners in most cooperatives allow you to use their capital for nothing. So cost of capital in a well-run co-op is extremely cheap. Now, you can use all the theoretical finance models and say, well, there's a discount and all these other things. But the bottom line is that member's equity is sitting there at zero cost. All you have to do is revolve it. So I think the model, and I think that if we look at market share of cooperatives across the ag base over the last 20, 30 years, the cooperative system continues to grow market share because they can do it net cheaper than anybody else. We look at what's going on in the commercial elevator space today, where we see a lot of the ABCs getting out of the country elevators, right? Because there's no money there. We're going to take our money, we're going to put it into food. We're going to put it into where we can get a 20% or 25% return. We're not going to sit out here and accept a 5% return on assets. Well, we have a dual mandate in a co-op. We have a mandate to serve the membership and have an economic return, but our bar is much lower. So we can run country elevators at those kind of returns, and everybody's happy.
So for the times that I've either heard or interpreted the waning interest in the next generation farmer's interest in patronage, that is not a signal that the legacy of shared prosperity brought forth by the co-op system is dead. That is over. Actually, we're potentially going into a period of growth. And I think it is interesting because you look at some of the major commercials, or most of the commercials, and aside from perhaps acquiring some country elevators as part of getting their hands on terminal assets on rail, or less so river, but mostly interior rail assets for shuttle loading, you are seeing not necessarily an exodus, but you're seeing a steady secular trend away from those smaller elevators. And so to your point, they're yielding an opportunity to the logical best competitor from a cost of capital perspective.
Right.
Concurrent with all this, the other interesting phenomena right now, and correct me if I'm wrong here, we have seen some significant consolidation in the last couple of years. And I'm thinking of, as an example, you take Keystone, largely in Indiana, but also in Michigan and kind of that territory. That has inspired fear among some smaller co-ops, if not just generally, maybe not fear, but a perception that they need to act, that is a competitive shot across the bow. Co-op of that scale suddenly coming together with the two previous parties. And this festers into this presumption that consolidation is our best available path to growth. So there's already a pre-existing, we need to grow the co-op. We're having a hard time delivering what we feel like is satisfactory growth. We then are seeing these big deals at our neighboring territories, perhaps on our trade borders, our trade area. So consolidation is what we have to do. So I hear a lot of talk about potential deals, potential mergers. Some folks are in exploratory work as we speak, but I'm not seeing a lot of actual deals close. So I feel like there's this disconnect between the chatter and the headline interest in it and the actual deals coming together. My question to you is that right? Or am I missing something? And I'm totally comfortable being wrong publicly here. But also, if I am right, is that new or different? Or has it always is this part of the normal cycle in your experience?
Now, I would tell you there's nothing different today. We started consolidating a farm in 1952. We've had consolidation of co-ops and ag retailers, both public or both cooperative and private, ever since. It's all that changes is the pace. I do think there is a new phenomenon. I think, as you mentioned, these very large retail organizations is a little bit different, and they have caused some smaller co-ops, I think, to dig in and maybe stick their head in the sand because they just got outdistanced and there's really no path for them, which I would tell you, and I've said this for years, that's okay if your membership's okay with it. You are owned by the farmers who do business with you, and we had a co-op in Nebraska that sat between us and Aurora Co-op, two of the larger local co-ops at the time, that was very, very small. And people kept saying, well, when are you going to merge them? And I said, whenever they want, but not till they want. And it took 15 years. And they finally said the membership, but the greatest thing about a co-op is it can be anything its members want it to be. But you just got to be paying attention. Now, we got to be careful with management, that management's listening, that they're not there for their own benefit, that they're there for the farmer benefit, and that they're not just protecting their job. But frankly, this has went on. But I think it's harder. We have so many of these larger cooperatives today. It's harder to do M&A in the larger co-ops because you get, first of all, most of them have done them. They understand them. They are painful. They are difficult. They can be destroyers of value if they're not done right. And do we have the talent to take over if we're a $1 billion co-op, or in Keystone's case, a $2.5 billion co-op, and we're going to merge another $2 billion co-op? How do I handle that in the talent realm is a really hard issue. Do I have the talent to bring my culture, which I believe has made us successful, to that new organization? Really a hard thing. And so I think there's hesitancy. And frankly, most co-op mergers have been done through pain, not through searching out opportunity. And I think we're on the verge of that. And I think that all this talk is just a forecast of what's coming.
So that's really interesting. In this world of, and I'm still going to refer to the Keystones and the CVAs, the Agtegras, the Landises as mid-sized Southern states, as the mid-sized co-ops, mid-sized relative to the CHSs and the Land O'Lakes, kind of the large nationals.
Let me interrupt you quick there, because I think there's a distinction there that's really important, and it happened. CVA was kind of the first mega local, right? And when we did that merger, I got accused of just being a regional. And when I just don't want us to confuse. So we never want to forget that farmers formed local co-ops to do what they couldn't do for themselves. And local co-ops formed regional co-ops to do what the local co-op couldn't do for themselves. So when we talk about a Keystone or a New or a CVA or an Agtegra, those cooperatives are owned directly by farmers, period. There are no associations owning those co-ops. When we go to a CHS, an AGP, a Land O'Lakes, those are primarily, now there's been a little bit of blurring of the lines, but primarily those are owned by local co-op associations.
They're by federated.
Yes. That's a different animal. And so that you got two kind of different conversations there, in my opinion.
Poorly executed mergers and acquisitions destroy more value than they create. they can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
So in that context, let's point to them as the larger of the locally owned co-ops. Because you have this market that has these much larger players, multi-state operators, right? Which unto itself is something that is notable as an evolution of the business. And to your point around many mergers in the past were born of pain or distress, perhaps. There's going to be less, for people to look at a merger and say, this is going to meaningfully move the needle. This is a rapid accelerant to growth that our farmers have told us we wanted. We believe we have the chops to pull it off. It's the right thing to do economically. A variety of business case rationales that'll sort of tip in there. But there's less sort of relative strength asymmetry between these large local owned co-ops, generally speaking. I mean, that also might be something that's sort of muting some of the activity, because if historically there was kind of this distress component, if that's not there, it just makes what's already pretty challenging negotiations around representation, board seats, voting rights. What do the shares trade at in terms of equity into the new enterprise? Those are sticky even now when you have a distressed party. And if you've got two strong parties coming together, I'm imagining they don't get a whole heck of a lot easier. So do you also see that is maybe muting it? And maybe we should expect to see maybe co-op growth comes more from picking off these country elevators that the commercials and privates no longer want to invest in, and maybe more of the really small locals aspiring to become larger locals as opposed to the large locals themselves getting meaningfully bigger. A lot there, I'm sort of thinking out loud.
Yeah, to answer it as succinctly as I can, the large locals are going to continue to get larger. And some of that is going to come through buying of privates. Some of that is going to come through merging other large locals. One of the challenges that we've seen is some co-ops, frankly, have waited too long. Some of the smaller co-ops have dug in too long, and they don't have much to offer. And it's one of the great things about a co-op is it takes forever to kill a co-op. You just have a black swan event. And so the first thing that happens is they mine the assets. And if you spend 10 or 15 years mining the assets and not reinvesting at the proper rates, what do you really have to offer in a merger other than the membership? After the merger, you're going to have to go in and close down locations. That's going to upset members. I mean, it makes it really difficult. And I've heard of large locals saying, if it's not going to move the mark in my business, I'm not going to take.
So, Carl, let's now shift towards beyond the conditions or the rationale for why folks might choose to pursue a merger as a vehicle to grow or acquisition of assets and from the privates. As a side note, in your career, what was the final count, or what is the running count, I should say, of how many mergers you were a part of yourself?
34 when it was all said and done. It was either I was on the senior leadership team or in the CEO chair. But that really had to do more with time. I entered industry in 93, and we saw some mass consolidation, and then we saw it wane, and then been through several cycles of that. So,
well, you can choose to discount the number as much as you want. 34 is a pretty big number. So you've been through this a lot. So I guess stepping back and sort of harvesting the knowledge of all those transactions that you were a part of, what makes for a successful strategy to grow via consolidation? And I'm interested in everything from how you establish a target to how you sort of structure it, how you get membership support, and of course, personally, for me, how do you manage integration? But across all of that, what are the main things that you would say, if we got these X number of things right, if we got this right, we were going to deliver net value at the end of the day?
Yeah, and first off, understand not all mergers deliver net value. Sometimes they are a long-term positioning without a lot of net value in the first 5 to 7 years, even at times. But the key I think one is you have to, if you are interested in growing through merger and acquisition, the most important thing is you have to run a successful organization. People won't be part of something that's winning. And so that's what I always focus on. I will tell you, in all the mergers that I was involved in, I never reached out to somebody and said, you need to merge with us. It was always somebody reaching out to us saying, we would like to talk to you about becoming part of your organization. So we always tried to live by pure cooperative principles, meaning we didn't attack other co-ops' trade territories, quote, quote. And we tried to run a great business and be a good cooperative partner. That's one of the challenges. The biggest competitor you have when you live in the cooperative world are other cooperatives.
Mm-hmm.
And that gets vehement, and that has stopped more mergers than it's helped. So probably without getting too lengthy in that, just run a great business and make sure you are positioned and have dry powder and have the ability to go through the downturn that you're probably going to go through, and or shore up, assets shortly after the merger, but do that. The other key is cooperatives were formed by farmers for the benefit of farmers. And I always believe that we have to be focused on meeting the needs of the farmer. We have to get the membership. I had a couple of merger votes when I was in South Dakota that I put the bar at 80%. If 80% of the membership didn't vote for it, we weren't doing it. And the laws are different in different states. Most are about a 50% pass rate, but we went above that and said, this is about the membership. And so keeping a focus that a co-op is here to serve the membership and is here for the benefit is the biggest key to a successful. And so we always did tons of information meetings. We talked to those owners, and then as important is making sure that you are giving opportunities to employees, because great co-ops have great people. And I always felt that was one of our differential advantages is we had the best people and we wanted the best organization. So those would probably be the things I would talk about without getting into the weeds of more than that. But there were too many co-ops that grew so that the CEO ran a bigger company or grew so the CEO could get a bigger paycheck. And we never grew for that reason. We grew only for the benefit. So the kind of the landmark merger that I was involved in was when we brought UFC and CVA together. And we literally put teams together and said, not including myself and the other CEO, we're not involved in these teams. And say, you show us the value this is going to bring to the membership. And I don't want to see any of this operational stuff. I want to see what is the value in the marketplace of a large organization. You had two about $700 million cooperatives at that time, which were fairly large, that were both highly successful. And we brought that to, but we did it based off the value it brought to the membership. So that we got to stay pure in that, I think.
Well, I think that highlights, you could look at the nature of your members, which are your owners, but are also your customers. You could look at that as an encumbrance or really a very strong, very quick feedback loop. We've worked with a number of companies, and we spend a lot of time establishing up front, reminding and reinforcing throughout the integration planning and ultimately integration execution that this has to be the benefit of the customer. And that shows up in many ways. One, we have to, within the business case, you ought to be able to articulate months before you're ever going to sit in front of a customer and try to explain why you're doing it. You ought to be able to articulate why it's going to be better for them. If it's all about cost optimization, removing costs from the system, how is that reduced cost going to flow through to the benefit of your customer, right? Some kind of a share of value. If it's all about offering more products and services, better technology, whatever it is, you ought to be able to articulate that early on. Oftentimes we get to the point where it's almost a retrofit. After the deal has been sort of consummated on paper, not publicly announced, now we're saying, oh, shoot, now let's figure out what's the PR release going to say? And that's where you get those kind of platitudes where you're thinking, my God, ChatGPT wrote this 20 years before ChatGPT existed, because they all look and kind of feel the same. And we also say from an integration perspective, you have to internalize the friction. You can't outsource all the pain of the integration to your customers. Your people and yourselves need to feel it. Protect your customer from it. Now, you could look at a co-op and say, my God, you have an additional hurdle of not only do you have to like agree that it's a good idea, find a suitable target, get their board to agree, but now you got to get every member to vote. And now here Carl's talking about 51% ain't enough. It's got to be 80%. But that's actually the values. It forces that discipline much further upstream. And so while it makes the job harder seemingly, it only makes it harder earlier, because that need to convince and to deliver value is going to happen yes or yes. You just have the obligation, or maybe it's a better way of putting it, you have the opportunity to work on that up front. And if you lose conviction early on before a member vote that there's actually not enough value there to pursue it, well, what a gift.
Right.
You don't discover that after you've already done it, because typically merger and acquisition, regardless if you're co-op or private, that's kind of a one-way door. You don't get to unwind that one 60 days later and realize this was a terrible idea. It is what it is. And so I think it's actually a way of reframing. You're looking at that membership base as a real asset and that immediate feedback loop. So whether it's 50, 70, 80, whatever the threshold is for approval, it's a pretty important asset for folks to think about.
Yeah, big deal.
Now, the other thing that I think it's important for us to talk about in kind of, again, harvesting your experience, Carl, strategy success. It's not only a reflection of management and execution. You also have the role of oversight and governance. And this is, you could have some of the same sort of platitudes around farmer boards, right? And people sometimes get really frustrated. I think it's a unique challenge. I think it's amazing to have your customers sitting on your board. I mean, again, what a short and immediate feedback loop. Got to get them thinking at the right level, but it's still it's an asset that a lot of your competitors don't have unless you're competing with co-ops. One of the things I've observed with boards generally is sometimes there's this tension between our role is to validate the strategy that management's bringing forward by asking questions to clarify, to stress test, to understand, but also with the tendency to say, okay, if I'm going to validate it, I'm going to kind of get into it a little bit. And so the boards get too deep into the strategy work itself, right? And that's problematic. Or conversely, you might have a board that is either maybe just uncomfortable challenging the executive team because they don't want to step on Carl's toes. Carl's a good guy. I like him. He's doing his best. I don't want to get in his way. Or maybe they have legitimate concerns about the management team's decision-making and strength or whatever. But they're not sure how best to raise that in the context of being in a director's seat. So as a seasoned executive who worked with boards throughout your career and speaking now to chairs of boards and board members that are listening and co-op executives that are listening today, what made for the best partnership between the CEO and the board when it came to level setting on everyone playing the right role such that it was additive in creating long-term value in executing strategy?
Yeah. I think the most important thing is we continually strive, and I think we all need to continue to strive, executives and boards alike, to continue to try to get a higher view. I think when we get in trouble is when we're not getting a view that's then higher than our farm or our little local co-op or whatever it may be. We got to continue to get out here and look at understanding we're in a consolidating world, has been, will be, probably not going to stop. We got to continue to get a higher view. I think that if I've seen an error in the cooperative system is there have been too many strategies or too much strategy work that has been the management strategy work and not the board, because the board doesn't always feel comfortable being there because they don't have a high enough view. And so that's how we address that. I had a good friend of mine, Brad Perry, one time say, is this the board's plan or is this the management's plan? Because we've seen a lot of co-ops have a lot of success, and then when that management goes away, the co-op falls apart, and the board didn't know or wasn't involved at the right level or didn't ask the right questions or didn't challenge. And so how do you get there? You have to have absolute transparency. Absolute transparency. First of all, you have to agree on why do we exist and what are we here for? Are we really here for the membership? Are we really, those types of things? What are our values? And then from there, and then everything comes off of it. Then it's just deciding whether, in my case, I always said, I don't want more than 5 key objectives in my co-op. I want 5 things that we're focused on. We got to keep it. There's there's just too much noise. When you have, at one time we had 12,000 owners, and they all had an opinion on how the co-op ought to be run and operate. And so that's why sometimes management just kind of closes off and says, no, we know when we're going here. And I think it needs to be board management together, discussing, disagreeing. Best decisions do not come from agreement, they come from debate. And so let's disagree, let's talk it out, let's figure it out, and then let's go forward and adjust as we need to adjust.
So one of the challenges becomes when you have a very strong and competent and successful executive, right? So performance struggles when the executive and the executive team maybe aren't performing.
Right.
And that will invite the board to maybe get a little bit closer and involved in this. But we also have a phenomenon where we've got some incredibly strong, long-term senior operators in these co-ops. How do you, whether you're the executive, sort of inviting the board to challenge you, and they're going to get tired of challenging you because you've been right so many times for so many years, or when you have turnover at the board, which we're having right now, you go into a lot of these meetings and it's dramatic shift in representation, just the age demographics.
Thank God.
And those folks are also coming in, and this is, thank God. But now they're looking at this CEO who their dad has had reverence for decades. So if dad wasn't necessarily pushing back, and I'm coming in green, my first time on a board, I'm a junior director, first term director. I guess how do you develop boards to have the strength and the competence and the courage to work and partner truly with a strong executive, period, but also in the context of shifting board membership and representation?
Well, I mean, boards are elected by the membership. They have a responsibility. And the membership has decided that you're qualified. And so now it's your job to do the job. So you should, as a board member, you should be self-educating. You've got to get to industry events and training and that type of stuff outside of your market, outside of your co-op. I'd say maybe even outside of your industry at times. I never expected a first year junior board member to come in and challenge it. They had to see the lay of the land. It takes 3 years, right? It takes some time. You have to learn the organization, the culture, but I mean, they've got a job to do. And the what's gone on in co-ops over the years is that management has done the board's job for them in many cases. And as long as it's all going okay, that's okay.
Mm-hmm.
But I told my boards more than once, if we blow this thing up, all I got to do is get a moving van. It's pretty hard to move a section of ground. So I'm not going to do your job for you. These are your decisions. And I just think that's a little bit of a purity of role, that the board is a board and the management is the management, and we have to figure it out together. But it can't just be Carl's plan or the CEO's plan. It's got to be the board's plan, because the entity is going to outlive any senior executive.
I think that is the key point there too, is if you're the executive and if you're getting results and if you've got this glide path to getting your strategy endorsed because you historically and currently don't have a board that challenges you, that's a great near-term set of conditions. If everything's going well, like you said, it goes well as long as it goes well. But legacy is about impact, the impact that you have when you're no longer there to do the work.
Right.
And if you want to build true legacy, where that co-op is prospering and successful and growing and providing service to its members years after you're no longer in the seat, yes, you can put your finger on the scale in terms of helping to cultivate and develop a successor. But developing that board, pushing that board, upskilling that board, inviting their criticisms, their challenges, their debate, ensuring their fingerprints on the strategy, that's one of the ways to have lasting legacy, because that doesn't turn over overnight. A CEO leaves. There's a day that they're the CEO, and there's the day that they're not. And I think that's a really good call to action for the folks that are listening. If they really look in the mirror, they say, yeah, you know what? I actually have a board that maybe there's some of their challenges are more performative than actual, or maybe I have outsized influence. And what am I going to do to leave this in a different condition for my successor, such that long-term members better served by the strength of this governing body? Carl, last question. You stepped down from your retired from your full-time role as the chief executive officer at Central Valley Ag in York, Nebraska, but you're still active and engaged. I guess, how are you spending your time now?
I always swallow hard when I say this. I mean, I'm available to do some consulting if people want that, really. But what my mission, my purpose today is just, what can I do to help co-ops? So, it doesn't matter size, scale, whatever. I'm doing some work with Land O'Lakes today, and still doing a little bit of work with CVA, and do a few sessions with Kansas Co-op Council and those types of things. And so whatever I can do to help the industry, I'm here. I'm available. This industry has been phenomenal for me. I mean, what a gift I've gotten, and certainly just want to give back and help co-ops do better. That's just that simple, and help farmers do better. So, not actively. Once again, I've been blessed. I don't have to work, but still love this industry, love agriculture, and so just want to help where I can.
Well, I think you taking the time today to share some of your thoughts. The hour was going by pretty fast here. It's amazing how that happens. I think you sharing your thoughts today and allowing us to amplify that message and put it out there, I think is a give back. We will certainly make sure that we've got ways for people to contact you in the show notes. And I would encourage our membership too, even if you don't, and our membership, our listenership, even if you don't necessarily know what you need, but you feel like a conversation with Carl's maybe going to help you frame up something that you need to be working on, I'd encourage you to reach out. And I've known Carl now for several years and have never once had a conversation that I walked away sort of uninspired by. And so take him up on his offer to stay engaged and to continue to help the co-op system. I think it's a great thing to not let the many decades of rich lessons learned, both through successes as well as maybe some things you think, I probably should have ignored my instincts on that one. Adding that back to help other folks avoid some of those mistakes, I think is great. And so I just want to say thanks for continuing to stay engaged. Thanks for your many years of service to the industry. And thank you for joining us today on the podcast. Well,
certainly my pleasure. And the work you're doing, I called you a few years ago and said, man, keep going, because you're hitting the right topics. And I'm just honored to get time to spend some time with you this morning.
Well, I appreciate it. Likewise. Thank you. And to our listeners, as always, I appreciate you joining and being part of the Pacesetter Pod community, taking the time to listen to different perspectives, to consider the applicability within your business, and then to really ponder and perhaps even action different things you can do to help improve strategy execution in support of growing your agribusiness. That's why we do this. I hope and trust you're getting value from it. I hope you'll let us know if you are, and more importantly, let us know if we're not. I always love to hear what we should be talking about, maybe we're not talking about. So thanks for joining today, and look forward to having you here next time on the Pacesetter Pod.
This is thepodcastfactory.com.